I found the sentence. It's in a document Wells Fargo filed with the federal government, available to anyone, sitting on a public website right now. And I need you to hear it, because this sentence is the reason this video exists. Here it is, word for word, from their own SEC filing. It is possible that our strategy could result in greater losses to holders of our debt securities, including the notes, than a different strategy would. That's Wells Fargo, describing what happens to certain investors if the bank runs into serious trouble, not in a private memo, not in an internal risk report, in the legal paperwork attached to a product they are actively selling to their own customers. Now here's the question nobody asks when they sit down with a financial advisor at a big bank. What exactly is the product they just described? It's not something designed for hedge funds or institutional traders. It's an income product, a yield note, a market-linked note. The kind of thing a branch advisor shows you when you say you want something safer than the stock market, but better than a savings account. The kind of thing millions of Americans in their 50s, 60s, and 70s are holding right now, without any idea that sentence exists. This video is about what that sentence actually means, who it applies to, and what you can do about it. Here's what most people believe when they put money in a big bank. They believe that bigger means safer. JP Morgan, Bank of America, Wells Fargo, these institutions have been around for over a century. They survived the Great Depression. They survived 2008. The government wouldn't let them fail. That's just the reality, right? And here's the thing. That belief isn't crazy. It's what the bank's marketing team has spent billions of dollars making sure you feel. And here's what most people miss. The game changed after 2008, and the change wasn't in your favor. After the financial crisis, Congress passed the Dodd-Frank Act. The headline version of the story was simple: no more taxpayer bailouts, no more using public money to rescue banks that made terrible decisions. Politicians went on television and promised the American people it would never happen again. Sounds like a win. Except almost nobody asked the obvious follow-up question. If taxpayers aren't covering the next banking disaster, then who is? The answer is already written down. It has been written down since 2010, and the specific mechanics of how it works, exactly which investors take the hit first, were spelled out by Wells Fargo in official filings with the U.S. Securities and Exchange Commission. Here's the concept you need to understand. It's called TLAC, Total Loss Absorbing Capacity. The Federal Reserve finalized rules requiring big banks to maintain it in December 2016. The official definition sounds harmless. It's essentially a cushion the bank must hold in case things go wrong. In plain English, here's what it actually means. If a major bank like Wells Fargo ever reaches the edge of failure, regulators have a plan. Instead of shutting the whole thing down and triggering a panic, they absorb the losses by writing down specific types of debt, transferring the losses onto the people who hold certain investments, so the bank can keep running. The investors who hold those investments, they lose first. The bank survives. That's the deal. Most people have no idea they agreed to that deal, because nobody in that branch office ever mentioned the deal existed. And this isn't some fringe theory. Wells Fargo filed documents with the SEC, documents available to anyone on the government's own website, that explicitly state this could happen to holders of their debt securities. Their own legal language says the single point of entry strategy they'd use in a crisis could result in greater losses to note holders than other approaches would. That's Wells Fargo, in writing, on the public record. But here's where it gets really important. The products most likely affected by this aren't exotic hedge fund instruments designed for Wall Street professionals. They're income products, yield notes, market-linked notes. The kind of thing a branch advisor shows you when you say you want something safer than the stock market, but better than a savings account. The kind of thing millions of Americans in their 50s, 60s, and 70s are holding right now, without any idea that sentence exists. Let's start with the product itself, because the average investor who owns one of these doesn't know exactly what they're holding. A structured note, income note, yield note, market-linked note, they go by different names at different banks, is essentially a loan you're making to the bank. You hand over your money, the bank promises to pay you back with interest at some future date, and in the meantime, it uses your money however it wants. That's not how it's described in the sales pitch, of course. In the sales pitch, it's a sophisticated investment product with downside protection, enhanced yield, and market-linked returns. The language is designed to make you feel like you're getting access to something institutional investors use. And here's why these products have exploded in popularity. The U.S. structured notes market hit a record $149 billion in issuance in 2024, a 46% jump from the year before, according to data from Structured Retail Products. That's not a niche product anymore. That's a mainstream financial vehicle being sold to millions of American investors. Investors buy them for a simple reason. After years of low interest rates, then a brutal period of inflation eating into their savings, they're looking for something that pays more than a regular CD, but feels safer than the stock market. Structured notes are framed as exactly that middle ground. But here's what the pitch leaves out. When you put money in a regular bank account or a CD, the FDIC insures it. You've seen the sticker on the door. Up to $250,000 per depositor per institution. That protection is real. It's backed by the federal government, and it has worked without a single failure since 1933. Structured notes have no FDIC sticker. They are unsecured debt obligations of the bank. If that bank gets into serious financial trouble, you are a creditor, not a protected depositor, and creditors wait in a very different line. This is the part most people find genuinely shocking. When a bank fails or enters resolution, there's a strict priority order for who gets paid. Think of it like a bankruptcy, because in every practical sense, it is. First in line, secured creditors, banks and institutions that lent money with actual collateral backing the loan. Second in line, depositors with FDIC-insured accounts, your checking account, your savings account, your standard CD. Up to $250,000 is protected. The FDIC steps in and covers it. Third, other uninsured depositors, people with balances over $250,000 in regular accounts. They're still above the next group. And then, further back, come the unsecured debt holders, the people holding bank-issued notes. FINRA, the Financial Industry Regulatory Authority, which is the government agency that oversees brokers, has issued investor alerts specifically about this. Their own language is direct. You could lose all of your investment if the issuer goes bankrupt, and investors who hold these notes are typically considered unsecured creditors who might recover little, if any, of their original investment. That's not my interpretation. That's the government's own investor watchdog warning retail investors in plain English about the risk they may not fully understand. And here's the part that will blow your mind. In 2024, $149 billion worth of these notes were issued in the United States alone. The market is growing by double digits every year, and a massive portion of that is flowing into accounts belonging to people in or near retirement, the exact people who can least afford to absorb that kind of loss. This isn't theoretical. We have real examples of exactly what happens to note holders in a banking crisis. The most instructive case is Lehman Brothers in 2008. Lehman issued structured notes, including ones marketed as having principal protection. Investors who purchased them received reassurances from their brokers. The notes would protect the initial investment. The bank was solid. When Lehman collapsed in September 2008, those investors found out what unsecured creditors actually recover in a bankruptcy. Reports from that period showed note holders receiving pennies on the dollar, in some cases less than 10 cents for every dollar invested. The principal protection turned out to be backed by the creditworthiness of a bank that no longer existed. FINRA actually went after UBS in 2012, more than 3 years after the collapse, because some of their advisors had sold Lehman-issued structured notes just months before the bankruptcy, without properly disclosing the credit risk to clients. UBS settled for $10.75 million. The common takeaway from 2008 was the big banks got bailed out, and they did that time, but the rules were changed specifically to prevent that from happening again.
The question is, if the bailout mechanism is gone, what replaced it? The answer is bail-in. The losses shift to creditors, including, potentially, you. And it doesn't require a crisis the size of 2008 to see this mechanism activate. In January 2026, Metropolitan Capital and Trust in Chicago closed its doors. $261 million in assets, the first FDIC-insured bank failure of this year. In 2025, 2 banks failed. In 2024, 2 more. They weren't headline events. They were Friday afternoon press releases that barely made the news. Let's look at this more carefully because the specifics matter.
Wells Fargo is the third largest bank in the United States with nearly $1.8 trillion in assets. They're required by law to file what regulators call a resolution plan, commonly called a living will, with the FDIC and the Federal Reserve. This is a document that maps out exactly how the bank would be wound down in the event of failure, including who takes losses and in what order. The SEC filings for Wells Fargo's structured notes include explicit risk disclosures about TLAC and the single point of entry strategy. The language describes a scenario where Wells Fargo would be the only legal entity to enter resolution proceedings, with losses imposed on shareholders and unsecured debt holders, including note holders. Their own filings acknowledge this strategy could result in greater losses to note holders than alternative strategies would produce. This language is buried in prospectuses and SEC filings. It's not highlighted in any sales brochure. The average investor who holds one of these products has never read the document that contains it, and many of the brokers selling them may not have read it thoroughly either. But here's what makes this even more significant. In December 2022, Wells Fargo paid $3.7 billion to settle charges brought by the Consumer Financial Protection Bureau for what the agency described as widespread mismanagement across more than 16 million customer accounts, wrongful car repossessions, improper home foreclosure denials, illegal overdraft fees, and accounts frozen without justification. The CFPB director called it a rinse-repeat cycle of violating the law. This is the institution writing the disclosures about which products absorb losses first. These facts are worth holding together. Here's a counterintuitive point that almost everyone gets completely backwards. The assumption is that the bigger the bank, the safer the investment. The logic seems sound. A bank with nearly $2 trillion in assets has plenty of cushion, right? And here's where it gets really interesting. The TLAC framework, the bail-in mechanism, only applies to what regulators call globally systemically important banks, or GSIBs. These are the biggest banks in the world. In the United States, that list includes Wells Fargo, JP Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, Bank of New York Mellon, and State Street. Your local credit union doesn't have a resolution plan on file with the FDIC. Your regional community bank doesn't have a formal bail-in mechanism designed into its debt structure. The smaller the institution, the less likely it is to have built a legal framework that specifically places unsecured note holders at the front of the loss absorption queue. The bigger the bank, the more likely that the specific product you were sold has been legally engineered to take losses before the institution itself goes down. Most people have this exactly backwards. This is where the conversation gets practical, because understanding the risk is only useful if it leads somewhere. First step: sort your statements into 2 piles. Pile 1, anything explicitly FDIC insured. Regular checking, standard savings, standard CDs, money market accounts at FDIC-insured banks, protected up to $250,000 per depositor per institution. Pile 2, anything else. Any product described as a note, an income product, a yield product, a market-linked product, or a structured investment. That pile needs a careful look. One important distinction that catches a lot of people off guard: there's a separate protection called SIPC that covers you if your brokerage firm fails. But SIPC does not protect you from losses caused by the underlying investments themselves.
If you hold a Wells Fargo issued note inside your Fidelity account and Wells Fargo's credit deteriorates, Fidelity's protection doesn't extend to Wells Fargo's obligations. You're still an unsecured creditor of the bank that issued the note. Second step, do the math on what the extra yield is actually buying you. If a structured note is paying you 1% more per year than an FDIC-insured CD at the same bank, that's $1,000 on a $100,000 investment. Is that $1,000 worth the difference between being in the protected pile and the creditor pile if something goes sideways? Most people, when they frame it that way, have a clear answer. Third step, think about diversification across institutions, not just across assets. Investors routinely diversify their holdings, stocks, bonds, real estate. Far fewer spread their cash across multiple institutions to maximize FDIC coverage. If your checking, savings, and investment accounts are all at one GSIB, you're more concentrated than you probably realize. Let's zoom out for a moment and think about what this actually looks like over time. 10 years from now, most people sitting on these products today will fall into two categories.
The first, people who never looked closely at what they own, never had the conversation, and continued assuming the bank had their best interests at heart. For most of them, nothing dramatic will happen. Markets won't crash, the bank won't fail. They'll collect their interest and move on. That's the most likely outcome, statistically. But here's what people in that first category are really doing. They're taking a risk they don't know they're taking. And a risk you don't know you're taking is not the same as a risk you've evaluated and accepted. It's just a blind spot. The second category, people who looked at this information, understood what it meant, and made a deliberate choice about where they want to be positioned. Not a panicked choice, a decision based on actually understanding the rules of the product they're holding. What separates those two groups isn't intelligence, it isn't financial sophistication. The people who end up in pile one are smart, careful, financially responsible people who were simply never told the complete story by the person who sold them the product. And that gap between what the SEC filings say and what most people understand about what they own is widening every year. In 2024, $149 billion in structured notes were issued in the U.S. alone. The market grew 46% in a single year. More people are being sold these products than ever before, and the economic conditions driving demand, uncertainty, inflation, the search for yield, aren't going away. People who understand this now have time to make thoughtful decisions. They can review their accounts without urgency, ask real questions, compare what they're earning against FDIC-insured alternatives, and make changes if they want to. People who find out at the wrong moment, not from a video but from a Friday afternoon press release, won't have that same luxury. And here's what stays with me. The disclosure is public. It's not hidden. It's sitting in an SEC filing on a government website anyone can read. The problem isn't that banks are hiding the rules. The problem is that the rules are written in language that requires a law degree to find and another one to interpret. You now have the framework. So here's where we are. You know what TLAC is. You know what an unsecured creditor is. You know that FINRA, the SEC, and Wells Fargo's own filings all describe the same risk in plain language that wasn't in the sales pitch. What happens next is genuinely up to you. Some people will watch this and decide their current setup is fine. They've looked at their accounts, they understand the trade-offs, and they're comfortable where they are. That's a completely legitimate choice, one that's a lot more informed than it was an hour ago. Some people will watch this and want to have a real conversation with their financial advisor, not an accusatory one, just a direct one. Ask them which of your holdings are FDIC insured and which aren't. Ask them where you'd stand in the creditor priority line if the issuing institution ran into serious trouble. If they can answer those questions clearly, that's a good sign. If they can't, that tells you something too. And some people will realize they've been sitting in the wrong pile without knowing it, and they'll want to move. The question isn't whether you trust your bank. Most people who find out their money is in the wrong line trusted their bank completely, right up until the Friday afternoon press release. The question is whether you understand the rules of the game you're already playing.
Now you do.